headlines lately, I think a lot of people have heard that Microsoft is moving downtown from Mississauga. We've talked about the CIBC building 2 towers by the Scotiabank Arena to house 30,000 employees. And so office space, I know, is at an all-time high. In fact, I heard that the vacancy rate for commercial now, office space, is just over 1%. And where typically equilibrium in a city is around 5%.
Not surprised.
You're tuned in to Boardwalk Talks with Monopoly Group Toronto, where we give you the latest news, tips, and tricks all about real estate investing so that you too can climb the property ladder. Visit us at torontomonopoly.ca.
So thanks for being here, Charlie. I'm so glad to see you here.
Mm-hmm.
And we were talking about the difference with the cancellations that just happened recently with Iconic Condos up in Vaughan and Cosmos as well too.
Right.
So investing in pre-construction and what are the risks?
Mm-hmm. Yeah, well, as you pointed out, those people in Vaughan, my understanding from an article in the Star yesterday was it's 2,000 people. They're getting their deposits back. That's the good news, but they're not going to get a condo they thought they were going to get.
I know.
And the other part of it is that in the last year and a half, there's been about 12 cancellations. Now, of course, you'd have to look at how many weren't canceled because we can see all the cranes around the city. But certainly, from where I sit, that is something that buyers of pre-construction are probably concerned about. And I was wondering, how could they mitigate that? And maybe you can talk a little bit about buying pre-construction condo for investment versus a resale.
Yeah, I mean, well, anytime you leave a closing for many years, you know, whether for a long time, right? Whether it's 6 months even, a long closing, or 4 or 5 years, as in the case of pre-construction, that can really cause, a lot of uncertainty in the market, and a lot can happen. It can go up or down. You never really know, right? So, as you mentioned, a lot of buyers that kind of get into pre-construction, they always expect it to go up in value. Mm-hmm. And in this case, certainly it has gone up in value, but it hasn't materialized because the developer canceled due to financing reasons, the financial viability of the project.
Mm-hmm.
Quite unfortunate. All that stuff is hard to predict because in these past 2 cases, they're high-profile builders and they have a good track record and track history of development. So it's unfortunate. No one expected it.
Mm-hmm.
It's kind of the risk that you get for leaving a long closing, in a sense.
Right. So, based on you've been in the business a long time, you've got a lot of experience with this. So, what would you counsel your clients when looking at an investment property? Maybe you can share the key differences between pre-construction. I guess that is pre-sale too,
mm-hmm.
and resale.
Well, with pre-construction, you're really putting down a deposit of, say, 20% staggered over a year and a half, and in about 4 years, the project gets built, right? Assuming you buy in the beginning. Resale, you have to come up with that 20%, or maybe you can buy as little as 5%, but 20% is general. What you put down, and then you'd have to save that all up and close on it right away. So some people don't have the means to have that deposit. They kind of need that kick from behind to kind of force the savings. Mm-hmm. And it's a great way to get started into investing into properties. Not to say that condos are the only way to invest in properties, but for the most part, there's a lot of control that you can get in it because it's relatively affordable. The way I look at it is that every condo that you buy you're guaranteed to pay it off in 25 years because that's when the mortgage is due, right? Within 25 years amortized by then. So you have a free and paid off property if you buy into that. Mm-hmm. Now, the good thing about buying condos is that they're relatively affordable, so you can buy it yourself, right? And you would have full control of it. You get to sell it, you get to release it, you get to increase the price, you can do whatever you want to it, and that's all your decision. Versus a larger multi-unit, multi-family residential property or commercial, you typically have a few partners in it, right? Mm-hmm. Or say you invest into a fund where you don't have full control over it. So I would say the smaller the property, the more control you have over it, which is why a lot of people like buying into condos. Now, whether you do it through pre-sale, where it takes time to save up for that deposits, or you buy resale and you have it right away and you start financing the asset, servicing the debt for that asset, that depends on the situation, right?
Mm-hmm. Now, you mentioned the amortization, and of course there's 25, 30-year amortizations, but I'm wondering if you buy an investment property, you rent it out, and you get the monthly cash flow, would you counsel your clients to do accelerated payments since the rent typically covers their monthly payments?
Well,
Would
it
you
doesn't
suggest
always.
that?
It doesn't always. Yes, of course, if you pay down your mortgage, the faster the better.
Right.
I always have the mantra where your home, your principal residence, should be paid off, and your investments should be as highly leveraged as possible. Because the difference is you get to write off the interest on your mortgage, right?
Right.
In your investments, not in your principal residence. So
Right.
keep that high if you can. But if you want to pay it down, that's also good as well too. I mean, obviously, the more you have paid down, the more cash flow you get out of it.
Right.
So it depends on the situation. Is I guess to answer your question, depends on their client situation, and yeah.
Right. So you've had a lot of experience on pre-sale condos and resale. And what's been your experience with pre-construction and your clients? Have you ever come across an example where the developer has changed their mind and canceled the project?
Thankfully not. Thankfully not. I mean, it's happened to some people with recently. There's a couple townhouses that went bankrupt in the past year or two. Now they're finalizing everything. Thankfully, it hasn't happened. It could happen. I mean, as much as we do our due diligence, we check on the history of the builder, the reputation of the builder, any kind of chargeable conciliations they had for Terrion, any kind of track record they have for that, the development status of the building itself. Now, oftentimes when you're buying pre-construction, they haven't got their final site plan approval yet. They're selling it before that actually happens, right? And there are certain things I can't find out. Like I won't know where they're borrowing their money from and what kind of rates they're paying and how much their input costs are, construction, all that. We won't know that, but we kind of see from the track record history of what their previous projects are.
Right.
Right. So it's hard to predict, and there is a risk inherently if you're using it as an investment vehicle. Like I said, the longer you keep it open, the more exposed you are to any kind of fluctuation, whether that's up or down or cancellations even for that matter. So it's hard to tell. I would say to my clients, if they have the means to buy something resale, maybe consider that, because you could see and touch and feel it, and you know what's out there. When it's built, you don't have all 300-400 units completing at the same time as you do as a resale, because they're already complete, and chances are everybody's selling and leasing at the same time is very minimal for resale, right? So in a sense, you have the product is, there's no competition when you're leasing it. Whereas
Right.
pre-sale, you will, but then you also get the benefit of that is that you get the new technologies, right? You get
Right.
a new building, new location, everybody wants to be there, brand new.
Right.
So, long-winded story. It really depends on the situation. If you have the means to buy something resale, do it now. If you want to leverage it out and make time to save for the payments, buy pre-construction. That's not bad too.
Right. So that's a great explanation. And so for people listening, once you get past that hurdle of making that decision, whether it's a pre-construction or a resale, then much like myself before I did it, and of course I use you to do that. My concern, and I'm sure a lot of people that have never done that before, is their fear of the type of renter they get, and do I want to be involved in that? And I know you've had a lot of experience. You've done this for a lot of clients, including myself, on 2 properties. So can you speak to the audience about how you navigate that and what are the best practices to help them do that?
Yeah, I mean, in terms of being a landlord, we do manage quite a few properties for people just out of need. It wasn't like we're mini property managers. I wouldn't say we don't charge for it, so we're not a full property manager yet. Eventually, we're building that division up, and we will be getting to that level. It's professionally managed, right? At the end of the day, there's not much that can go wrong with it. Right, and you're within 4 walls. If it's a condo, that is.
Right.
You're paying maintenance fees for a reason. You don't have to worry about the maintenance, exterior maintenance for the most part. The condo corp handles most of that, and there's little nuances for sure. We had a situation where one of our clients didn't get landlord insurance, and we didn't inform them to do so. We should have, but they didn't do that. Of course, their toilet flooded. and it's not the tenant's fault for that to happen, right? I mean, the component of the toilet, no one would have known that. But the cause was that it damaged the flooring, it damaged the unit below, which was thankfully just common elements. Still cost money, but they had to pay out of pocket for that,
Right.
because they didn't have insurance. Had they had insurance and paid the $100 or $200 a month,
Right.
which they gladly would have, they just didn't know that was the situation.
Right.
That would have saved a lot of problems. So, barring that, there's not a whole lot that can go wrong with the property. You won't need a new roof. If it happens, the condo would. I mean, ultimately, you'd have to pay through it for maintenance fees, exterior replacements. But a lot of the building components are part of your maintenance fees. I mean, there's somebody professionally managing that. That makes sense.
Right, and it's important to have an experienced salesperson that can help vet these tenants, and certainly that's been my experience. I understand a lot of people would do it their own. There's certainly many ways to advertise for a prospective tenant and do background checks and proof of income and everything.
Yeah.
But certainly when you're dealing with experienced realtors, they have a vested interest in making sure that their client's property is being occupied by somebody that will pay the rent every month.
Yeah,
and
for sure.
And look after the property.
For sure. I mean, at the end of the day, we want our clients to have a turnkey solution where they don't have to worry. I mean, they're investing it, they're busy, right? So, and we do this every day. So we want to help our clients manage, like yourself as well too.
Right.
We want to help our clients not have to go through these headaches. And and I think that to get back to that long-winded question about how we do that, little tips and tricks, is that we make sure that all the screening is done up ahead of time, right? So if they have good credit, then chances are they're going to pay their rent. They have a good history of, success leaves clues, and so does bad track records as well too, right? So if they're not paying their rent on time, chances are they're not going to pay their other bills on time either. But if they are, then they are going to pay their bills on
Right.
time. Now, there's no way to know how they live, how clean they are, and all that kind of stuff. You can't really judge that. But what do you care at the end of the day? If they live in a mess, that's fine. That's okay. Let them live in a mess. But when they leave, it better be clean. I mean, it's going to be vacant, right? And you
Right.
send a cleaner in there. And there's nothing that can't be fixed, in a sense, right? So,
Right. And there's certain steps and levels of protection you can put in the agreement.
Right.
And certainly one of my concerns was, I didn't want to rent to somebody that was going to be an absentee renter and then post the unit on Airbnb.
And that's happened to us once before. So now we need to look for that as well too, right? So it causes a lot of friction, and for the tenant renting it, and also for the landlord, because the landlord's getting messages from the condo board saying stop Airbnb, but the landlord's saying it's not my fault. I didn't know that. The tenant's going there; they're getting denied entry into their into their unit, which they're renting right now. So it just creates a lot of chaos for people, and it's unfortunately it's the bad apples that ruin it for everybody.
Right.
So for those people that are watching or listening that are afraid of being a landlord, we take a lot of that stress away from them, and not even just us. A professional property manager would do that. Any kind of realtor that you're working with should be able to do that as well too. And at the end of the day, it all makes sense, right? I mean, if your place is costing, I don't know, let's throw a number there, $2,500 a month to carry the place. A tenant is paying $2,300 a month. You're losing $200 a month. At the end of the day, depending on your mortgage, you're still paying down equity. So as long as you can stomach the $200 a month that you're losing, you're going to gain at the end. In 25 years, you will have a free and paid off condo. Plus it goes up in value. Plus eventually, right now it might not be cash flowing, but in 5 years, rents are going to go up. And when the tenants eventually inevitably leave, you're going to get the new market rent of $3,000, $3,500, whatever it might be. And then you start earning cash flow.
Well, I can certainly vouch for that experience in both the cases as well, which is the rents eventually catch up to those payments. And back to that point of those are the exceptions rather than the rule. And certainly those exceptions make headlines, but the overwhelming majority don't have an issue, and there's a lot of reputable people that want to rent properties in downtown Toronto, and they're professionals as well, and they have great credit scores. So I think what you're saying, Ken, to allay everybody's concerns is that there's checks and balances, and that's where a professional like you or someone on your team can help people take through the process. Because prior to me doing it, I had all those same concerns, which is, oh, what if I get a bad renter? What if they don't pay? What have you? But I've had a good experience, and not to say that there won't be bumps in the road, but once again, somebody who's gainfully employed and this is an investment for them and that's not their expertise, much like everything else in your life, whether it's an accountant, whether it's a lawyer, what have you, you want to rely on people that have good expert opinion and have your best interests in mind.
Sure, for sure, and it really takes it. That's the whole point of investing, right? So that you're leveraging your money and have somebody else use their time to help you earn profit and kind of grow that way, right? But at the end of the day, speaking with bad tenants, it's over the hundreds or even thousands of tenants, landlords that we've managed for. I've only noticed 3 that were bad. 3. And now that we've had that experience, we know what to look out for.
Right.
How to quickly mitigate that situation if it does happen. You know,
Right.
serve the N4s and the N12s and boot them out and all the
Right.
landlord tenant board stuff. Eventually, they're gonna have to pay. Whether you lose some money, it might happen that you might lose a month or 2 in rent if the off chance, the very low chance that you get a bad tenant because we didn't do the screening properly or they somehow tricked us. But in the end of the day, they want a place to live. They want to be not disturbed. They want to have reasonable enjoyment of their place. The tenants, that is. The landlord wants to have income coming in, at least help offset some of the cost. And you know, at the end of the day, in 25 years, you can be well set because you made the decision, the financial decision, to put down your 20% of your property, whether that's 100, 150, 200 grand, whatever it might be. The tenant didn't have that money, it doesn't have that money, they don't have the means to have that money, but they need to live downtown and they want to live downtown in a place that is, you know, your place. So they're happy to pay the rent. And I don't know, it just makes sense. In theory, it all makes sense, right? So,
And in practical terms, many people are doing that.
right. I mean, doing what, the landlord? Or the,
Yes.
Yeah.
Yes, in practical terms, there's hundreds of examples that you have within your own practice, and then of course, when we look at the entire region in aggregate, we know what's happening, and the demand, especially downtown Toronto, is perfect for rental stock to come online.
Yeah. So the situation, Jonathan just had a listing for one of his portfolio clients as well too, and he listed it the very next day. Actually, that same night, he had an offer already, over asking, and then by noon the next day, he had 8 showings booked, and it was just a run-of-the-mill condo on Yonge Street somewhere, Yonge and south of Bloor, around Wellesley, around there. And tons of showings, and all the candidates that we're getting are great candidates. You know, so any tenants out there trying to look for a place, you can see how expensive everything is getting, how hard it is to get qualified for a spot because there's more people in line that are just as good as you or better. So the demand is there, I think.
Right.
You know, the vacancy rates are really low in Toronto or Ontario for that matter, but Toronto especially.
Right, and just to add to that, you know, the Toronto Monopoly Group, you know, I like your tagline, helping you on the property ladder, climb the property ladder, and that's exactly what you're doing, not just from an investment point of view, but to your point earlier about having, at some point, your own children, helping them with the property ladder, because we know that real estate's not getting any cheaper in Toronto, and that to get into the market, basically you're securing a great jumping off point for your children or for yourself in retirement.
Yeah, so I just had a coaching call last night. So my business coach said something really amazing. He's like, you know, if you have children, your children, you should have at least 1 condo for every child that you have. You should have minimum 1 condo for every child you have. 1 investment property anyway, for that matter. It makes sense, right? Because say the average bedroom downtown, 1 bedroom downtown is now what, 500,000? Call it 600,000. Average condo downtown is actually 640,000 or so. But say it's a 1 bedroom for 550,000. 25 years, you'll have 550,000 in today's dollars. imagine you had 550,000 today to care for your children, right? That would pay for education, their car, their down payment on the first house, their wedding maybe even, right? So why wouldn't you do that? Just to
Right.
make that decision to put down that small deposit, or not small, but 20% deposit on your investment property to do that. So that's what we're doing, helping our clients climb up the property ladder. Eventually, maybe you might want to trade that condo or a few of those condos to a multifamily property or even a commercial property or something that's a little less intensive, I guess you could say,
Right.
right? So the benefit of having multifamilies is that if one tenant is gone, you're not going to lose your shirt. You're not vacant for that long. You have more economies of scale, I guess you could say, right? So it costs less to hire a gardener or a landscaper when you have that, right? With commercial properties, the tenants are the ones that handle all the payments for everything. So
Right.
if something goes wrong with the place, you know what? Sorry, tenant, it's your fault. I mean, you fix it, you pay for it. We're just giving you the shell. It's a net lease to the landlord. So the landlord would get the net
Right.
rent.
Right, and for the audience who own homes, they certainly understand the level of maintenance required that they have to be involved in, which getting into a condo, obviously, there's not that level of maintenance because you're paying that maintenance fee, and everything outside those four walls is being looked after. And then I would say also inside the walls, if there are issues related from the builder, then those will be taken care of too. So we're talking a much lower maintenance investment.
For the condo, yeah.
Yes,
for sure.
absolutely.
It's a great way to get started.
Right.
Absolutely.
So I would say what you want to do is help your clients get onto the first rung of the investment property ladder.
That's the first step, first rung for sure. Get 1 or 2 or 3 or 4, 5 condos even. And then when you want to move to the next rung up the ladder, you're going to trade those condos up for a more diversified property, a more higher asset class, to say, right? Whether it's a sixplex in somewhere, right? We have 6 tenants, or it could be a retail space or an office that you're like, even the space we're in right now is rented, right? So that would be the next asset class, right? And then you can diversify from there. So essentially, it's like going along the game of Monopoly and trading in the properties that you have for a hotel or a larger unit, right?
Right.
So that's our mantra. That's what we try to do. Now I know we had an earlier talk before this. Fortunately, it wasn't recorded, but we were talking about the benefits of owning real estate, right? The 4 pillars of income in real estate.
Yes, please.
So, and
an
you're
important
experiencing it now. So
Yes.
that's awesome that you're going through it. After owning a couple properties for a few years now, they're gaining equity and gaining traction. I'm not sure if you're cash flowing or not, but number 1 pillar I'd
Yes.
say is cash flowing. So the excess of income versus expenses. If you get an excess, then it's positive cash flow. It's negative and you have to throw money into it, it's negative cash flow. But as I mentioned, number 2, the reason why it's good, then the second pillar of real estate income is equity pay down. So essentially, your mortgage is getting paid off just by paying it. So there's 2 components of a mortgage: there's principal and interest, right? Then you pay taxes and maintenance on top of that. So as long as your maintenance, your taxes, and your interest are covered, you're gaining. Anything in excess of that, you're gaining in equity. So just by paying your mortgage, you're probably paying, I don't know what your mortgage is, but say a typical $400,000 mortgage, you're going to get $10,000 to $12,000 a year paid off just by paying a 25-year amortization on it. So that's what you're earning, $10,000 to $25,000. The third pillar of real estate income is the tax benefits that you get from it. So you get to write off depreciation, repairs, maintenance, all that stuff, the interest on your loan, that's tax-free. And then also the biggest benefit, in my opinion, is capital gains. So when you go to sell it, you only get taxed on half of the asset if it's an investment. If it's a personal residence, you don't get taxed on any of it. It's all tax-free. So that alone of earning income is tax-free, or a portion of it's tax savings. That's huge, right? You know, if we go out there and sell coffee, for example, we're going to get taxed on the profit of it, 100% of the profit, minus expenses and all that, right? With real estate, you get taxed on half the gain, which is a huge benefit for Canadians. And the final pillar is obviously the best one, is appreciation, right? So not only will rent appreciate, which will help with the cash flow and equity pay down if you choose to pay down, if you accelerate your mortgage payments, but what will really happen is that you get appreciation because values will go up, I think, based on, you know, you were talking about this morning about new businesses coming to Toronto, right? All the tech
Yes,
businesses.
yes. It's been in the headlines lately. I think a lot of people have heard that Microsoft is moving downtown from Mississauga. We've talked about the CIBC building 2 towers
It's
by the
huge.
Scotiabank Arena to house 30,000 employees. And so office space, I know, is at an all-time high. In fact, I heard that the vacancy rate for commercial now, office space, is just over 1%.
Not
And
surprised.
where typically equilibrium in a city is around 5%.
Not surprised.
So that's driving up office rents. Once again, supply and demand. There's been much written over the last few years about why are companies doing this? Because the workforce, the people they want to hire and retain, want to live in downtown Toronto.
Yeah.
Because it's the whole live, work, play concept. And they don't want to commute.
Well, why would you lose an hour and a half each way of your life, 3 hours a day, towards commuting? That doesn't make sense to me. I don't
Yeah.
get it. I don't get why people do it. I don't get
Right.
why they do it.
And in fact, as you know, Ken, much has been made about developers now looking at and already building larger units to accommodate families because of the demand, to that point about people not wanting to commute, but they need a bigger space.
Sure. Or what I've seen right now, the trend is children's play areas, like the amenity spaces. So it's kind of like the beehive mentality, where you kind of go home into your little beehive in a sense, but then everybody kind of gathers in communal spaces, and your living room now becomes the amenities, or even outside of the building in the city, for example. And that's what Google's trying to do with their whole land share. They're trying to innovate on top of ways where buildings can connect. I think it's the final layer of their thing, the connectivity of the
Yes.
different communities that they're trying to do with either technology or whether it's computer technology or just building technologies, and try to make all the communities integrated somehow, right? So that could mean, I'm not that innovative, so I don't really know, but it could mean a community center even, for that matter, but like a
Right.
digital community center,
Right.
where you can exchange messages for buy and sell based on localized communities. I don't know, but the whole point is that your living space doesn't have to be in your unit itself, right? People are coping with less and less square footage because it's becoming more and more expensive, because the land is becoming more and more expensive, and so they're making do with less space.
And that's not unlike older prominent cities in the world, right? Whether it's New York, whether it's London,
Right.
Hong Kong.
Right. Oh man.
So it really is all about the growth that the city is experiencing, and it's driven by business.
It's density at the end of the day,
Yeah.
right? And yes, you're right. It's driven by businesses, and it's just a big snowball. So I had a friend that works in an accounting company, and they're moving up to Vaughan. They're trying to move the headquarters up to Vaughan. But from the inside, he was telling me it doesn't really make sense that they're moving up to Vaughan, because all the businesses that they serve, all the big businesses, are downtown. So meanwhile, they're trying to say, we service you, we're also downtown, but really they're not. They're trying to move to Vaughan, and this whole thing
Right.
fell apart because it's not going to happen. It hasn't really snowballed yet, right? And I think that's why these 2 projects got canceled. It has something to do with it, I'm sure. But at the end of the day, everybody wants to be where the action is, right? Downtown,
Right.
I think.
And so, from the perspective of your clients, looking for where the growth is and where the best opportunity for an investment property is, certainly this won't come as a surprise to anybody listening or viewing this, is that in downtown Toronto, that's where the growth is. And talking about minimizing risk on an investment, when you look at the demographics, the projected growth, everything that's going on, not to mention I don't know how many cranes that there are,
Yeah.
but there's a lot of great indicators about what's happening in the city and the housing supply that's being required, not just today, but in the future too.
So we were just looking at the numbers recently, and we noticed that detached housing in the New York region has actually dropped 20% since the announcement of the new fair housing plan, right? It's dropped 20% to an average of, I think it's over $1 million now, but downtown condos. Downtown condos have actually raised by 5.5%, and they're still going year over year around 10% increases. For that reason, first of all, the asset is half the price of a house. Yes, it's higher per square foot, But at the end of the day, people want to be downtown, and they'll make do with less square footage because of all the action down here.
Right.
So if you were to invest in something, I would say downtown Toronto condos. It's a great way to start, and then eventually you can move up to different asset classes depending on what you're looking for.
Right. And you and I were also talking about how you're finding your clients that bought their first condo have got equity, and now they're looking to buy a newer condo or maybe a larger one, retaining their existing condo and renting that out.
Yeah, I mean that's a great way to exit. I mean, exiting a real estate investment doesn't have to always mean sell. You could always refinance the property, take out less of the equity, not all of it, take out 65%, 80% of the value of the property, and you take a line of credit on it or remortgage it, and there you go. You get your initial investment back, and you still retain the asset. Guess it'll cost you more monthly, but again, when you refinance it, it'll be 25-year amortization. You're paying it down again, right? So that's also a great way. Take that equity out, put it in another property, do the same thing, let that grow a little bit, do it again, and do it again, and just grow, right? It's kind of like going around the board.
Right.
So it's a great way to do it, and oftentimes a lot of people buy pre-construction as a way to kind of force the savings into that, and I thought that's how I got first started, and that's how Jonathan started. You've done it as well too.
Yes.
And I think it's a great way to kind of start getting invested into real estate if you don't know what you're doing. Leave it in the professionals' hands, like the builders, the developers.
Yeah.
Picking the right one is the issue, though, right? Because of the cancellations that we had in the media recently. And we were talking about brainstorming about different ways that we can, the government or somebody could step in to have protectionism towards that, right? And
Yeah, I think without any, as they say, draconian measures from the government, there should be probably, I think people would agree, as long as there's some sort of time limit when they put down their money, where there's got to be a trigger point where they know the project's going to go ahead, that's not, 3 or 4 years later for the developer.
well, they do have that. So
Yeah.
Tarion has a process for that. It's an outside occupancy delay, or they have some sort of forward critical dates that they track. So just for those of you guys listening that don't know what Tarion is, it's a government body, or it's supposed to be a third party neutral company that's supposed to help consumers and at the same time developers and just bridge that gap, right? So it's like an independent government organization. I don't know what you call it. But they make sure that you hit these critical dates, and they're very lenient, they're still flexible, but in order to build a brand new construction in Ontario or to substantially renovate, you need your Tarion permission. You need to be certified by Tarion, and there's hoops to get through to get that, right? So to have that protection, which everybody wants that warranty, you're gonna have to meet certain criteria, and nobody wants to take that away. It's hard to get that licensing in the first place, and to get it taken away from you based on negative reputations, that will hurt you, right? So that kind of keeps developers on the ball.
Good.
So there is a sense of protection, and also to talk about the deposit protection as well too. For freehold, they insure up to $100,000 of deposit, up to 10% of the value of the purchase price, and for condos the same thing, but only $20,000. So it's not a whole lot of protection if the builder goes bankrupt or whatever, but at the end of the day, there is some protection. There is some warranty protection as well too. Yes, there could be further measures for protection towards canceled projects, but I would challenge and ask, what would be a good way? I mean, there's certainly a builder's reputation, but when there's a lot of money on the line, they could just fold up and start something new, right? I think it comes down to awareness. I really think that you should do your homework, and buyer beware. There's inherent risks of buying pre-construction. Certainly a lot more benefits. There's certainly a lot more completions than there are non-completions, a lot more. But in the off chance that you get a cancellation, I mean, it's kind of the risk that you take, right?
All the more reason that you need somebody that's experienced and professional and a trusted advisor to help someone, especially if it's their first property,
Right.
to trust and help them through the process. But one thing's for sure, if they don't get on the board,
Yeah, if you don't take action, right, you won't
Right.
get started. And,
Right.
and the sooner, like they always say, don't wait to buy real estate and wait. And when's the best time to plant a tree? It's yesterday. And when's the next best time? Today, right? So they always say things like that, and it makes sense because at the end of the day, real estate's a long-term game. You're buying and holding. That's the best way to make money, in my opinion. Not flipping, buying and holding. And what you're gonna do is the sooner you get started, the more time you have, right, to realize those gains. So I'm trying not to. My whole message, my whole mantra now is to get everybody into action, right? Just get started. Whatever it might be, scrape together whatever you have to do, just get started, or at least have a plan to get started.
That's the biggest hurdle. But I would say, as somebody who's been through it, it's important that you have a trusted advisor to take you through it. And I trust this discussion we're having today will be informative to the listeners.
I hope so.
And obviously they can contact you for more information.
For sure. This is TorontoMonopoly.ca, get some more information. But let's not sell them about us, because they all know about us and what we do. I'm just talking about real estate, investing in real estate in general. Do you want to talk about how you got started in it? How you first kind of, aside from your home, right? How did you get invested into the condos?
Well, for me, I realized when I first started working downtown, this goes probably around 2000. I'd always lived and worked in the suburbs, and then I got transferred to the office downtown. And first of all, I just loved the whole energy of the city. And I lived at Harborfront, and I realized, this is where I wanted to live. And my first place where I lived at Queens Quay in Spadina in 2003, from my condo, I could see all the way north, all the way to Front Street. So City Place did not exist.
It's a golf course.
Right? There was the golf course.
Yeah.
There were the two condos right on Front Street. But between between the Gardiner and Front Street, there was nothing. And I saw within 6 years, before I moved from there, the massive growth. And so I realized early on that the growth of the city. So that's what led me to buying, on Bathurst and Lakeshore pre-construction. And whenever I mention to people when I bought that condo in 2006, they don't even have to ask me what I paid, because based on today's prices, they know that it was a lot less.
Yeah,
so
of course.
To me, that's a good example. And I can tell you that the first tenant just barely covered the monthly mortgage and maintenance. It was nothing I couldn't handle. But by the second tenant, as the rent started to go up, I was starting to get into positive cash flow. And then now for the last 6 years, I've had a professional couple that have lived there, and they're great tenants, and the rents have gone up, and it's nice cash flow is what I would say.
For sure. And you're not, if you are raising rent on them, I forgot, but if you are, it's very minimal. In fact, it's mandated how much you can raise rent.
Correct.
Like less than 2%.
If you're asking me my advice on how to manage tenants, if they're great tenants and they pay on time and you have a good sense that they look after your place, then I know there was a couple of years I didn't even raise the rent.
Yeah.
Because I don't want them to leave.
Yeah, keep them happy.
Because I think the mistake that people can make, and I've talked to other friends that have multiple condos too, is you think you're going to get a lot more rent, but then the gamble you have is if you lose 1 month's rent, so you're out that 1 month, plus you're rolling the dice on the type of tenant you're going to get.
Yep.
So that's been my experience.
Yeah, so you have vacancies, you have real estate
Right.
fees, acquisition costs,
Right.
and all that kind of turnover. It's expensive, right? For
Right.
sure. So it's better to just keep them happy and just leave it
Yeah.
and get another property.
Yeah.
Re-leverage if there's equity in the property, in your own home, wherever it might be, borrowed sources. Just buy another one and do it again,
Yeah.
right? At the end of the day, you're planting a seed for 25 years from now.
Right. And
Every
so,
time you buy one.
right. So I think the message here, Ken, is if you're not in a circle of people that have done this, right, or maybe you've just heard about it and you don't know how to do it, this all goes back to talking to someone to help you to help you through it.
For sure.
And I know I know you're not big on selling yourself, but ultimately it's the actions that you take, with people that ultimately is the proof that you're gonna be trusted. I think that's a big part
Sure.
of the brand.
Sure. And yeah, I mean, it's the proof is in the pudding, and I'm glad you've taken those steps. And I remember you were considering selling that at one point, and thankfully
Yes.
you didn't.
Oh no, no. Yeah, exactly.
Yeah.
Because you start looking at the equity and you start saying, hey, what can I do with that money? But then, as you pointed out, because of that equity, you can borrow against that,
Mhm.
and then use that to refinance and then invest in other properties.
Right.
And look, I want to make it clear that you're not minimizing that there's risk, but I would say any investment you have to calculate the risks and then make a decision.
Yeah.
And when you look at all the factors that are going on in Toronto, I'm a big believer in looking at statistics, and not just from an agency, but from government sources and industry sources, so you get a good sense of what's going on, because people work for their hard-earned money and they want to make sure that if they're going to invest in something, they've got a reasonable chance of success and minimize the downside. And I think in life that's all you can do, is when you're investing money, is look at the risks and try to minimize the downside.
Right. In a growing city like Toronto, like you mentioned, all the
Yes.
reports, the employment and everything coming into there,
Yes.
I don't think you can go wrong.
Yes.
And we're undervalued compared
Yes.
to this world.
And to me, certainly people say, well, look at all these cranes and look at all these condos, and certainly I've thought that too. But if you look at the underlying factors that's driving that, it's, to me, the big part of it is the business aspect of it, is companies relocating downtown, big 5 accounting firms putting up towers, banks. You look what's happened, south in the southern core, and those are all encouraging signs as to all the housing that needs to support all these businesses moving downtown.
Well, forget about the accounting firms. There's also like big industries like the tech firms, the big 4 or whatever,
Exactly.
Apple, Google's, and Microsoft, and
Right. Well, I
whatever it
mean,
might be.
you look what Google has planned with the Sidewalk Labs. With Waterfront Toronto, you can look at what's happening in East Harbor. There's going to be massive retail, residential, office there, and certainly with city planning for transit, that's another indicator, is to accommodate the explosive growth that's happening in the city.
So your bets are on Toronto.
I've been saying for a long time, you can't bet against the city. It's the largest city in Canada. It's the hub of the country, and that's not to say that there can't be fluctuations in the economy. I would never say that. But ultimately, people from around the country, where are they going to move for the best jobs? And not only that, I've worked downtown now for 15 plus years, and I'm just astonished at the diversity, not just the people who live here. I mean, these people who work have come from other countries. You can hear every language, because these companies are hiring people that can speak multiple languages, especially in the financial services industry.
Sure.
That manage funds. So that's the other bellwether for me as well.
For me, it's the food. The restaurants are.
Yeah, no, that's a good point. That's
Tons
a
of all cool, diverse restaurants that you have.
Yeah.
Like anything you feel like you can get in the city, which is awesome.
that's a really good point. So yeah, I think we've talked about a lot of different factors, but ultimately, as human beings, we have a fear of loss, and that is a much bigger driver than prospect of gain. And that's not my opinion. That's based on science and psychology. And so I think that's where, once again, trust advisors come in to mitigate the fear of loss. Because I think all too well, I think people can see through whether it's financial advisors or real estate persons, wherever they have to invest their money, they can see through people that basically saying, don't worry, you know, there's guarantees and you can never lose. And I think those things really, especially for the educated population have in Toronto, I think things like that don't fly.
Right.
I think it's being truthful, trusted, giving the facts, because they're professionals in high-paying jobs and they're educated.
Right.
So they can do their own research as well too. They know what's going on in the marketplace, which I think is a real benefit, by the way. Now that we're talking about the release of more information about sales.
Yeah, and the Toronto Real Estate Board just recently released their sold data.
Right.
They're forced to release their sold
Right.
data.
And I think putting more information in the hands of educated people, right, is better for people that want to help them, that do a really good job in the industry.
Yeah. Yeah, because now
There's a meeting of the minds.
that's right. Now you no longer have to rely on us, like real estate agents, to give you the information and gatekeep the information
Right.
on
Right.
sold prices. It's all public knowledge now, and then
Right.
you kind of know what the values are, right? So
Correct.
it's good in terms of balancing the market in a sense,
Correct.
right? I totally agree with that.
Correct. And so when somebody finally, in my opinion, searches a real estate advisor, then they're already, and certainly you can speak to this, I can only speak for myself, they've got information in hand because it's easy for them to get information on listings, you know, now with video, the photography, they can come armed, and I think they're already at a certain point where, yes, I do want to make a buying decision. Now I need somebody to help me to find that spot, and
Well-
it saves them a lot of time.
Yeah, it's also not just the finding part; it's the negotiating. It's a
Exactly.
high value transaction, so any little small twist of the tongue can
Exactly.
make a huge difference. in it. So,
Exactly.
yeah, for sure. There's value.
That's
in that.
exactly right. It's the negotiating,
Yeah.
and not all negotiators are equal.
Yeah, for sure, for sure. So you mentioned something about, actually we were talking about growing the portfolio in Toronto, being a large
Yeah.
city and all that, and growing makes sense and never selling. But you know what, I just want to bring something to the audience that maybe it is a section of your life where it's time to actually sell and diversify, because you can't take it with you at the end of the day, right?
Mm-hmm.
You can build a legacy, you can keep it going forever, but at some point you're going to have to sell, or you're going to need to take some money out, or you're going to want to maybe.
Yes.
Whether you pass it down to other future generations, or you know, maybe now it's time to actually quit your job and you know, retire off of it,
Yes.
right? So we shouldn't say that always hold on to it. There could be a time where it is time to sell, or maybe you're selling to trade that asset class into another asset class.
Sure, and I think that's a good point, which is if your goal is to hold it for 25 years, that's one thing. But if you're 5 or 7 or 8 years, or you've got your life changes,
Yeah.
then you've got the opportunity to cash in at certain points as well.
Yeah, why wouldn't you want
And,
to have
and
those
take
options?
the equity out
right.
to have that option.
Right.
Yes.
Right. But if you can hold on for the ride, right?
Yeah. But as you say, I think it's a good point. People's life circumstances change, and you know, and you've got a good foundation.
Well, Charlie, I'm glad you're on this ride with us. I'm glad you're playing the game with us. That's awesome to hear that, and you know, wishing you much future success. as
Yeah,
well.
yeah, and I think it's you mentioned a game. It can be fun. You want to take the stress out of the game
Yeah, I mean, at the end of the
and
day,
make it fun, because it can be fun as well. I really believe that.
yeah. At the end of the day, it is a game. Life is a game. I'm gonna get into a whole nother philosophical
We will.
thing,
That's
but
for another time.
you know, life is a game. It's all a game. It's just how you play your moves. I think, and just kind of like figure it out. It just all comes together somehow. Anyway,
Great.
cool. Thanks for
Good
joining
talking
us.
to you. Thank you.
If you like what you just watched, don't forget to click to subscribe. We're on Apple iTunes and YouTube as well. And visit us at www.torontomonopoly.ca. Thanks for watching.